Hello friends, I am CMA Deepansh. Today, let's understand what is India Vix and how to read it in simple words. We're going to demystify one of the most talked about indicators in the Indian stock market. We'll break down exactly what it is and more importantly, how you can use it. So, let's get started.
Every single move in the market is really driven by human emotion. We've all been there, right? That nervous feeling before a big economic announcement, or that excitement when a stock you own just starts taking off. These feelings, they're not just in your head. They actually ripple through the entire market. Just imagine for a second, what if there was some kind of tool, a number, that could actually quantify the collective anxiety or the calmness of all the traders and investors out there? Kind of like an emotional barometer for the market. Well, that's our topic for today. That tool exists and it's called the India Vix. It's designed to do just that, to measure market fear. And I promise, by the end of this, you'll get how to read it and what it really means for you. So let's dive right in and start with the absolute basics. We've been talking about measuring fear, and this is the tool for the job. But what is the India Vix exactly?
Well, the VIX in India Vix stands for Volatility Index, and its whole purpose is to give us a forecast. But here's the key. It's not looking at the past. It's trying to predict the expected choppiness or the price swings in the market over the next 30 days.
Now, here's what makes the VIX so powerful. It's not based on opinions or some kind of survey. It's calculated by the National Stock Exchange, and it uses the real-time prices of Nifty 50 options contracts. You can think of these as bets on where India's top 50 companies are headed. So this makes it a purely data-driven way to measure expected market movement. And because it has this predictive nature, it's earned a pretty famous nickname. While the official name is the Volatility Index, you're going to hear it called something else way more often. And here's why. A high VIX number suggests that traders are really bracing for some big moves, and maybe even some downward ones. Fear and uncertainty are high. On the flip side, a low VIX signals that the market is expecting things to be stable and calm. Confidence is pretty much the mood of the day.
So whenever you hear somebody mention the fear index or the fear gauge, you'll know they're talking about the India Vix. It's a direct reflection of how the market is feeling.
Okay, the actual formula is pretty complex, but the logic behind it is actually quite simple. It all comes down to the price of options. Think of an option like buying insurance for your stocks. When traders think there's going to be a lot of volatility, a storm coming, they rush to buy this insurance. And all that high demand drives up the price, or the premium of these options. The VIX just reads these higher premiums as a sign of turbulence ahead, and so its value goes up. Okay, so we know what it is and the general idea of how it works. Now for the fun part. Let's get practical. How do we actually read the VIX number and make sense of it in the real world? So imagine you look at the market and the India Vix is just sitting there at a low number, like 12. This level is basically telling you that market participants aren't expecting any major shocks anytime soon. It's a sign of a calm, stable environment. But then, let's say some crazy, unexpected global news breaks. All of a sudden, uncertainty just floods the market. You might see the VIX jump, and I mean jump fast, to a level like 25. Now, this isn't just a number changing, it's a huge signal. It's telling you that the market is now pricing in the chance of some really big swings. Fear is definitely on the rise. Here's a simple little cheat sheet to help you read the numbers. A VIX between 10 and 15, that's generally considered low, a stable market. The 15 to 20 range is kind of the normal zone. But once we get past 20, we are entering a high fear environment. And anything above 30, whoa, that often signals extreme fear, maybe even panic.
So this is great and all, but how can we actually use this information? What does a high or a low VIX mean for our own investment or trading strategies?
And this is where it gets really practical. For a long-term investor, a high VIX, which we know signals widespread fear, can actually be a green light. It often means really good, quality stocks are being sold off cheap just because of panic. It can be an amazing buying opportunity. For a short-term trader, a high VIX means bigger price swings, which creates more chances to profit from all that movement. So the general strategy is almost backwards. When the VIX is high and fear is everywhere, that's when you should be looking for opportunities. And when the VIX is low and everyone is feeling comfortable, that's when you should be a little cautious because the market can sometimes get caught off guard. Now, while it's a little bit of an oversimplification, this old market saying really captures the spirit of using the VIX. It works because markets often overreact to fear, pushing prices way below their true value. But they also get way too complacent during calm times, which can happen right before a downturn. It's a really powerful idea to keep in mind. And that's the India Vix in a nutshell. Look, it's not a crystal ball, but it is an incredibly useful tool for taking the emotional temperature of the market. So the real question is, now that you know how to read this fear gauge, how are you going to use it in your own strategy?